Hello. Yes, so we've covered the basics of capital gains and losses. In this video, we're going to go through superficial losses, and we're going to talk about a couple things that can change a cost base or perhaps proceeds, government assistance, and I think I'm going to try to jump to warranties. I'm going to try to fit it all in this one video. I'll have a timer running now, so it won't be as long as the last one, but we'll see what we can fit in. So just share my screen and we'll get started. Now, I might have said it quickly, but hopefully you remember I mentioned that allowable capital losses can only be applied against capital gains. So if I have taxable capital gains in a year, I can use my allowable capital losses to subtract from that income inclusion. So if I had two shares, one's doing really well and the other's falling off, but I think this company's going to make a recovery. So I sell these shares, recognize a huge gain, and then I sell these shares at a loss so I can subtract from that gain in the year. And then I immediately rebuy those shares at the same price so that I can ride it back to its increased value because I think the company is going to turn around. So the CRA looks at this and says, well, you still have the shares. Like you still have the shares. You're still in the same sort of economic position. You took part in this transaction only to reduce your capital gains. So this is what they call a superficial loss. So a superficial loss looks at the 30 days before and after a particular disposition. And what they're looking for is to make sure that you didn't just replace the asset you sold. If you sold some shares, did you immediately replace them? And I think the reason they use 30 days is because share price can be volatile. After a month, okay, if there's been a recovery, maybe you lost out on it, maybe something, but we're kind of it's hard to say a person knew what was going on. If you sell shares and then later you see something happen, you're like, oh, that's probably going to go back up. You should still be able to invest in it. They just have this 30-day gap to make sure that that reinvestment is a real reinvestment and not just a superficial disposition to save taxes. So this is what superficial loss does. So if there was a disposition in capital property that resulted in a loss, and the same property was purchased either 30 days before or 30 days after, so the whole window is 60 days, then the superficial loss can reduce that loss even to potentially nothing. Um, on the 30th day after disposition, did the individual still own the property? Were they in the same position really that they were in a moment ago? So what they do with this superficial loss is they add it to the ACB of the replacement shares. So if I originally bought the shares, the value went down and I sold and repurchased, they say, well, that change in value is your loss. But if it's a superficial loss, we're just going to add it back to your cost base. We're just going to add it back. Your cost base is still the same. So the administrative concession allows superficial loss to be equal to the proportion number of shares repurchased. So let's say I had 10 shares that I sold, but I only bought back six. They'll say, okay, well, then those six shares you repurchased will be at their cost will be added back to where they were. So this add back to costs is the same reduction of the capital loss. So we are not recognizing the loss since it's not affecting your taxes, it's going back to your cost base and will reduce any future gain the same as your cost base originally was. So these superficial loss rules are basically just sort of undoing the transaction, but you still have that cost base available for the future. So it's important to know superficial loss rules when tax planning because people often consider selling certain losing assets and capital when they have a big capital gain they're looking to protect. So you can say, yes, we can do this, but we have to be mindful of when we repurchase the shares because we don't want to be caught by the superficial loss rules. So an example of this, 100 shares were bought for 15,000, sold for 10. We have a loss. On December 22nd, on January 5th, so that's only a couple weeks later, we bought back 100 identical shares for $8,000. So we had this loss in 2024 of $5,000. So the new ACB is going to be the $5,000 superficial loss plus the cost we rebought. So now our cost base is $13,000. So we're removing that cost, we're removing that loss from our income. And now our cost base is 13,000. Now it's even lower than our cost base originally. So we might not want to do it in this situation because we actually lost out on $2,000 of potential capital losses we could have used to protect gains. So this asymmetrical result is intentional. The government wants superficial losses to be unappealing. If you have a cost base of 15,000, the best way to protect that cost base is to leave it as is. So let's go straight to the example for superficial losses. We're just about 6 minutes in. So Miss Kinski owns 1,000 shares of board. The cost was $23. On August 20th, she sells the shares for $14.50, a loss. And on August 25th, only 5 days later, she repurchases $600 shares, or 60% of the shares she sold. And her new cost was $13.75. She continues to own these shares throughout the remainder of 2024. What's the consequence? So there's a couple parts to this. One is we have to figure out what was the initial capital loss. She bought the shares at $23, so it would have cost her $23,000. She sold them at $14.50, so her proceeds would have been $14,500. That means her original capital loss is $8,500. That's what she's reporting on her tax return. But she repurchased 600 shares 5 days later. So she's not actually experiencing her loss. She's still in the same place she was for 600 of those shares. So what we do is we take that original capital loss and we have to figure out how much of that loss needs to be added back to our tax return and added back to the cost of our new share purchase. And what we do is we take a percentage. Since we have shares repurchased were 600, so 600 divided by the 1,000 shares we originally sold, we repurchased 60% of those shares. So 60% of our original loss is superficial. So when we multiply that by our 8,500 loss, $5,100 of the loss shouldn't be allowed. $5,100 was superficial. It's a loss that only appears on the tax return because we still have the shares. So we're going to remove $5,100 of the capital loss. So our original capital loss was 8,500. We're removing 5,100 or adding it to income. So our capital loss went from 85 to $3,400. What do we do with capital losses? Well, we have to half it. That 50% inclusion, the allowable capital loss is $1,700. So our original capital loss was 8,500. It changed to 3,400, having a $1,700 effect on our income. But what's the new ACB of the shares? Well, we bought 600 shares at $13.75. That cost us $82.50. And we have to add back what we calculated our artificial loss to be. Our artificial loss was that 5,100, 60% of the loss we sold. So we will add that back to our cost. So our total cost for our repurchase shares is 13,350. So there were 600 shares still held at the end of the 30 days after, and therefore 600 shares were still held at the full 60-day period, the 30 days before and the 30 days after. So keep those in mind. 30 days before and after, that's a 60-day window that we have to be considerate of. Their next subject, so that was about 9 minutes. So our next topic is ACB considerations. How do I say this? When we discuss cost, we're talking about how much money we've given up to gain something. But certain things can occur that can get us money back. Perhaps there's a rebate or some sort of refund, or as an example that we'll go through in a minute, government assistance. Government assistance says you bought something, we're going to support you by giving you some of that money back. So what we do with that money is it subtracts from our cost base. I spent $18,000. The government gave me 8,000 back. So I'm not out 18, I'm out 10. So my cost is $10,000, right? So these are a adjusted cost-based considerations. Now, what if I spent $15,000 and the government gave me 18? Well, they gave me back more money than I spent. So that means my cost base is a negative. Cost can never be negative. If your ACB ever has an adjustment that makes it negative, the cost becomes zero and that negative becomes a capital gain. So I spent 15,000, I got back 18, I got back $3,000 more than I paid. I got back $3,000. That's a capital gain. I've improved my situation by $3,000. So when you have adjustments that result in a negative amount, that negative is immediately recognized as a capital gain, and the cost base becomes zero. So just to go through what this slide's saying, ACB defined as cost plus adjustments minus other adjustments. If the adjustments exceed the cost, then a negative ACB results. So Tax Act Section 40 says we're going to treat the negative ACB as a capital gain, which is added to income, and then we apply that add back to the negative ACB, restoring it to nil. So if my ACB is negative 3,000, I have to add $3,000 to the cost base. Therefore, I need to add a $3,000 capital gain, which is a $1,500 taxable capital gain. GST and HST. So sales taxes are meant to apply to individuals. So if I bought a car for $30,000, in Ontario, 13% is 3,600. So I bought it for 30,000. I paid 33,600. Because I don't get that money back, that additional outlay is the cost of my car. Businesses and companies, anything they pay for HST, they get back from the government. Sales tax is a tax on individuals, not businesses. So they paid $33,600, but they're going to get that $3,600 back as an ITC when they file their tax return. Since they get it back, the money they receive subtracts from the cost. So $30,000 plus HST paid minus HST ITC. ITC means input tax credit. So we're adding 3,600 and subtracting 3,600. So it's easier just to say when it comes to business purchases, we kind of just don't include GST, PST, but we do for individuals. So the capital cost of depreciable property is reduced by government assistance or any government payback. So the property is reduced by the ITC recovered. Even though I spent $33,000, I got $3,000 back, so $30,000 is my cost base. So we'll do the next question. That is 351, I believe. Or 51. So treatment of government assistance. There is a purchase of real property at a cost of 5.6 million, but 600,000 represents the land. So the building was $5 million. The building's new, will be used exclusively for non-residential purposes. They put it in a separate class 1 to qualify for a higher CCA rate. So a new building, non-manufacturing, uses 6% in class 1 instead of 4. We got government assistance, 1.4 million for the building, 100,000 for the land, combined to 1.5 million. What is the cost of the land, the cost of the building, and what CCA was claimed? So we originally paid 5.6 million. 5 million was for the land, 5 million for the building, 600,000 for the land. So we need to separate this out. Our government grant gave us back 1.4 million for the building. So we were out 5, but then we got back 1.4. So we're only actually out 3.6 million. So our adjusted cost base for the building was 3.6. Our land, 600 minus $100,000 grant. Our land cost is 500,000. So that's what's sitting on our books. That's our cost. Buildings are depreciable. They can have CCA. They said we used a separate class 1, which is 6%. So 3.6 million times 6% is 216,000. Because it's the year of purchase, we apply the half year rule. So times 50%. But ACCI rules, if you remember chapter 5, is currently doubling our half year rule. So that puts us back to 216,000. So our $3.6 million at 6%, our maximum CCA we can take is 216,000. So that is because our cost base of 5 million was adjusted by our government grant. So our building only cost us 3.6, not 5. So that's the important factor there. We are 15 minutes in. Do I have time? I'm going to skip identical properties. I'm going to do that in the next video. 16 minutes. I want to jump to warranties. So sometimes when you sell something, you give it a warranty saying, hey, here's a machine. If it breaks in the next 90 days or something, I will come and fix it. But sometimes warranties have an extra cost. So give me $4,000, and if it breaks in the next year, I will come fix it. And the act of fixing it's going to cost me money. So warranties, so the money I receive for the warranty gets added to the proceed of disposition. If seller receives consideration for warranty on or before the filing due date, the amounts included in proceeds of disposition. So they gave me money, I will add it to proceeds. If it costs me money before the tax date, the filing due date, so for a business, it's 6 months later. So if before I file my return, I have an expenditure, I know what it is before my filing date, I can include it. So I can subtract the expenditure. So they gave me $4,000 to keep the machine fixed. I had to go out and do some tune-up, so it cost me $1,500. I got $4,000. I paid $1,500. So that additional outcome, that $2,500, is going to add to my capital gain. It's additional monies I received. If the seller receives consideration after the filing date, the amount is treated as the amount received is treated as a capital gain, expenditures treated as capital loss. We've already filed our return, so we're not going to refile the return for the additional monies gained and spent. It's just going to go on to next year's return as additional capital gain and loss. If I received more money, that's going to increase the gain. If I spent more money, that's going to apply the loss. Okay? So just a brief example, just to help drive that home, because I know I did it kind of fast. We're going to jump to exercise 8-5. So during the tax year, Extract sells capital property. Its cost was $237,000. The proceeds were $288, but they received an additional $4,000 for a warranty, which was paid at the time of sale. So did we receive $288? No, we received $292. We added that $4,000. The company provides the purchaser a 2-year warranty. It estimates $3,500. We're not too concerned about that, but we care about what did we spend. To fulfill the obligation, the company spent $1,100 on March 4th, 2024. The sale was 2023, December 31st. So it's very likely we haven't filed our tax return yet. So, and if this is a business, the tax return's not due until the end of June. So our March 10th, 2024 was before our due date. So we are going to reduce our proceeds by the money spent. We collected $4,000. We spent $1,100. After our filing due date, we spent an additional $2,800. So how does this look? In the 2023, that's when we made our sale. We collected $292,000. We collected $288 plus a $4,000 warranty payment. Our cost was 237, so we're going to subtract that, but we're also going to subtract that warranty outlay, that amount we spent to fix the machine. So we spent $1,100. So our gain includes all three. So our total capital gain in 2023, the year of the sale, was 53,900. Our taxable capital gain was half of that, 26,950. After we filed our tax return in next fiscal year, we had to go back out and fix it again. And that cost us an additional $2,800. Well, that cash outlay is a capital loss. Half of that is a $1,400 amount. That's $1,400 allowable capital loss. So we can subtract $1,400 from any taxable capital gains in the year. If we have none, then that capital loss can be carried over. It can either be carried forward indefinitely until we have a capital gain to use it, but we can carry it back up to 3 years. And since we had this capital gain last year, we can take this $1,400 and subtract it from our taxable capital gain from last year. We'd have to refile our tax return to do it. Oh, actually, I think we can just file it on a Schedule 4. I think we can file it on Schedule 4. So we would say, hey, we're going to take that allowable capital loss, we're going to apply it to last year's return. And so that's what's going on. So those warranty payments received and cash outlays are modifying our capital gain loss. In the same way that government assistance, cash received, reduces our cost base, warranty cash receives add or subtract to our proceeds of disposition. Okay. So that allows us to do 3 exercises. We covered superficial loss, government assistance, and warranties. If these videos are going too quick, please let me know. Send an email you want me to slow down and I can do it. Otherwise, hopefully that helped explain those 3 things. When we come back, we will talk about identical shares and modifying cost when you have lots of the same item. So thank you for your time. See you in the next video.